to offer its members, sponsors, donors, and philanthropists many options in which to support the Naval War College Foundation and the Naval War College and its mission to educate and develop leaders by building strategic and cultural perspectives and enhancing the capability to advise senior leaders and policymakers who are charged with preserving our national security and outlook for the future. We remain so very grateful to our trustees, regional directors, trustee emeriti, members, sponsors, and friends for their continued support and advocacy for the oldest and preeminent institution of its kind, the U.S. Naval War College. The Naval War College Foundation, powered by its generous members and donors, provide critical funds needed to support the Naval War College's unique ability to develop military and civilian leaders who are skilled in the strategic and operational challenges of today and tomorrow, are dedicated to preserving national security and a global position of leadership, and are adept at navigating the challenges of war and, most importantly, the prevention of war. We are particularly thankful for the Naval War College Foundation's many Heritage Society members who have provided generous estate plan gifts which support the mission for the Naval War College Foundation by sustaining a curriculum at the college that is focused on three principal areas: military preparedness, leader development, and diplomacy and statesmanship. Heritage Society members are prominently recognized on our plaque in Spruance Hall on the Naval War College campus, located here in Newport, Rhode Island. Like many plan gifts, membership in the Heritage Society and similar programs helps to sustain the college for posterity. Therefore, I'm extremely thankful for your time and attention this afternoon. The Naval War College Foundation is pleased to present this seminar for our valued members and donors who care about our national security and who want to learn more about how planned giving will not only leave a legacy in an area that is of great interest or concern to them, but also benefits a world-class institution charged with developing military and civilian leaders who have taken an oath to protect our national interests and way of life that will benefit our children, our grandchildren, and our great-grandchildren. I want to now introduce your keynote speaker for this afternoon's seminar, Mr. Eric Archer, a Rhode Island lawyer with 35 years of estate planning and planned giving experience. He has served as the Director of Development for Roger Williams University and for the Naval War College Foundation. He continues to advise the Naval War College Foundation as well as Salve Regina University and other local Rhode Island charities on tax and plan giving matters. He is a graduate of Colgate University and UConn School of Law, and now practices with his wife, Deborah Foppert, at the firm of Archer & Foppert, LLP in Jamestown, Rhode Island. Following Eric's presentation, we will have a short Q&A session, so should you have a question, please hold it until after Eric's presentation, and he'll try to address as many of them as time permits. Ladies and gentlemen, without any further ado, please give a warm virtual welcome to Mr. Eric Archer. Eric?
That's a very kind introduction, and thank you for taking the time during everybody's very busy day to listen in here. And we worked through some of the logistics before we came on. I certainly welcome questions, even as I'm chatting, to make sure that the questions kind of match what I'm talking about. I don't know logistically how it'll work, but give it a shot. And I think George will be monitoring chat as well. If for any reason people would rather type in their questions. So before I go to my PowerPoint, I'm a lawyer, so like any lawyer, I'm going to start with a bunch of disclosures, and I'll start with some very important ones. One is I don't have any great inside intel on where the taxes are headed right now. Believe it or not, there is sometimes a link to upcoming legislation through the estate planning community. If you go to the highest end estate planning seminars, which I try to get to once in a while, and they're populated by the big firm, big cheeses, the IRS usually sends representatives to kind of ask the estate planners, who are more numerous and in some cases, you know, the heavier hitters, what they think about upcoming legislation and how it can be formulated. And they do use the input of estate planning attorneys to try to carve out future estate planning. And right now we've been in a void. We've heard nothing about what's coming up. So disclosure one is I don't have intel information right now, and I think overall I don't see that 2020 year-end 2020 is going to be a critically important date, although it's always hard to tell. I mean, I don't think that there's anything about to expire by the end of 2020 that if you miss it, you've missed some major opportunity. Normally we get a little bit more advance notice, but I've heard of no major changes. But I will be talking more about kind of trends in the estate tax and income tax law that make plan giving a pretty important part of an overall financial plan, and obviously a philanthropic plan. And I think overall, I see trends that I'm fairly confident are going to continue that play into plan giving. I do think that if people start to understand sort of how plan giving works and some of the opportunities and options that are out there, all of a sudden something might pop that accomplishes a lot of different things at once. The last disclosure I will offer is everybody's always kind of curious in this day and age, political orientation, whatever. I have been driven so far to the middle by all that's going on politically that I will say things like, well, I think that this will give the Democrats a chance to blah blah blah. My overall take is that both sides of this circus are a little crazy, and I don't have a strong orientation, but I will say what I think will be some political implications of the change in administration. Obviously, tax law is more set by Congress than presidents, so I don't see a major change in how estate taxes are formulated, or income taxes or capital gains or anything else I'll be touching on, just by virtue of a change in the presidential administration. So I will move to turn now to the first page of my my PowerPoint here, which is why make a plan gift at the end of 2020, which will be at the top of each of my slides. Overall, I don't think it's got to be by the end of 2020 for some of the points I'm raising here, other than timing of when a person would want to make a year-end gift any year, and considerations about whether to possibly straddle a year, and looking in terms of income and other trends on a multi-year basis rather than all at 1 year. And I'm going to start with an example of somebody in a lot of ways. The example I offer will be like me, with one notable exception. The first example I'm offering is that some wise person chose to invest $50,000 in Tesla a year ago. I thought about investing in Tesla a year ago, but did not do so. So that's a major distinction between me and the example I'm offering here. But if you use a highly, incredibly, inconceivably appreciated security as an example of how to consider where plan giving might come into play, it'll help illustrate. So this example will go all the way through. If a person invested $50,000 in Tesla a year ago, my math tells me it's now worth $448,776,000. Almost all capital gains, and as long as it's been held for more than a year, it's long-term capital gains. And it's easy enough to look at what the tax implications of that are if you do nothing. So this page, I'll be quiet for a couple of seconds so you can skim through it. But this page shows that doing nothing would, in a basically a moderately taxing state, would trigger about $103,000, $104,000 of tax on the gain since 1 year ago. That's capital gains tax. The immediate observation on these numbers is that one of the reasons that the tax is so high is that if you happen to trigger capital gains all in 1 year, even if your own income, your own day-to-day day job income is not off the charts, the fact of that one-time gain puts you into the category of a wealthy taxpayer. And there are any one of a number of tax provisions that kick in that are aimed at the wealthy, but that could apply to anybody if they happen to have just a very lucky year like this. Another situation where, gain like this in a 1 year basis could happen is you inherit some securities that don't have a high cost basis, or possibly even sell a vacation home or something else. But the fact that a person even of modest means might have had some securities that appreciated incredibly well, that would all be sold in a single year, can put you up into some tax levels that are not that you're not accustomed to. So really, the first point about planned giving is it is a way to take cards off the table and convert the value that is built into a successful portfolio or a successful security and turn it into an income stream on its full value. So one thing that planned giving could do for our lucky Tesla owner here is to convert the full $448,000 of sales price, $449,000 of sales price, into an income stream. Not the $335 or $345 that would remain if you paid the tax, but the full amount of that $448 can be converted to an income stream. There would be a gradual, there would be some capital gains on the income stream that's paid as it's received, but that does two things. It postpones the income that is on that gain into the far future, and it also avoids the surge in income, the spike in income that could be incurred by somebody saying these securities were either grossly undervalued on 12/4/2019 or grossly overvalued on 12/3/2020, probably the numbers in between. I'm taking these cards off the table. So this illustration will go through the next few slides as well. So I'll go to the next one. Here's the other thing that just my lay observation is we as a country have spent a tremendous amount of money this year. And it breaks down into $6.5 trillion. And I wrote that all out to see how it looks. And one of the more staggering things about that number is in the entire nation's history before last year, the entire deficit, the entire debt had risen to 32 trillion. So for that impact in a single year is something that it's going to steer some of the near future. There's going to be pressure to tax, not just because of a change of administration, but because both sides of the political aisle are understandably concerned about a $6.5 trillion addition to our long-term debt. So that's just kind of a non-tax consideration. And I'll move to the next slide. And this one's a little dense, and I apologize for that. But as an overview, where are we going to find even 6.5 trillion to at least reduce and stem the tax burden that is possibly going to be working in our future? And those numbers aren't really the type of thing you can do by tweaking with income taxes. The body of wealth that could make an impact on a 6.5 trillion or a $30 trillion deficit is the overall transfer of wealth that's going to be taking place between the boomers and the boomers' babies. And I'm kind of a tail end of that whole population, but those numbers, $30 to $70 trillion of money transferring generations here, are going to be very much in the target of our nation's taxing authorities for a few reasons. One is taxing transfers of wealth on death doesn't tend to put the brakes on the economy. People do not die, they make their death decisions based on the taxes that incur, and it is a relatively non-damaging way to raise taxes. We happen to be at the tail end of an incredible relaxation of the federal estate tax laws. for decades, my practice was centered around planning for people who were over that $600,000 threshold, and the 50% tax that would kick in above $600,000. And that threshold is now $23 million. So that from now until 2025, the federal estate tax exemption for a couple is $23 million. So I look at my practice, been doing this for 35 years, have, whatever hundreds of clients. I only have a dozen or so people who have to worry about a $23 million estate. So estate taxes aren't going to be the solution to the deficit and the spending that we've incurred lately, unless there's a major reversal in terms of how those taxes are assessed. And my sense is that the target for addressing the spending is going to be either the capital gain that is pent up in this $30 to $70 trillion transfer of wealth, or possibly estate tax on that transfer. So towards the bottom of the slide is the other ideas that have been tossed around. One that is already that was in the Biden platform is to tax capital gains at the same rate as ordinary income, at least for the wealthy. So if you either are a very high income earner and already and make just $1 million in day-to-day salary, or if you have a major tax event, one of those that I mentioned, either a boom sale or a sale of vacation property or something like that, you may be the wealthy. And a concept that has been tossed around is, why don't we just have, why is there a distinction between capital gains rates and ordinary income tax rates? Why don't we just tax all the money that a wealthy person earns at the same rate? And you will see that the $138,000 I had projected before for capital gains jumps up to $179,000, assuming a top wage earner. So that's out there. That isn't entirely possible. Is that income at certain thresholds will be the capital gains income will be taxed as ordinary income. Another one, and this one causes shudder through the estate planning community, is to eliminate the step-up in basis for securities that are received through an estate. So because of the fact that there could be an estate tax, historically, if you inherit a highly appreciated asset from the generation above you, let's say, or even from your spouse, the appreciation on that asset is eliminated for the purposes of capital gains. You receive that same Tesla shares through an estate that I outlined before. The cost basis would be its current fair market of $478,000, and capital gains are therefore eliminated. It would be one of the most unpopular things to ever try to pass, because trying to recreate basis from things that were acquired either in your long ago past or your folks long ago past is going to be brutal. So there's probably going to be some safe harbors, and won't be situations where the basis would be zero, but there might be elective basis options where you can say, hey, if you can't prove a higher basis than this, you can deem your basis to be X and such and pay a bunch of capital gains. The reason I mention that as a possibility is if people become sort of accustomed to the very high rate at which the federal estate tax kicks in, there's a tendency to say, okay, well, that door's closed. What other tax can we raise? And a step up in basis, or eliminating the step up in basis rules would actually raise more revenue than a return of the federal estate tax levels back to a $3.5 million level that was tossed around a few years ago. So capital gains on appreciated assets is a huge pot of potential tax revenue that, if it's ever taxed, it's going to be a very, very complicated thing to comply with. And the last one is I am willing to stick my neck out on this one. I mentioned that currently the federal estate tax kicks in at $23 million for a couple. At long last, there's a credit that is awarded to a couple rather than an individual credit to one spouse in the couple, and it simplifies things in a sense, because a couple is given a credit to use, above which things will be taxed at 40%. And if it's $1 million is used in the first death and then $22 million in the second death, that's all fine. You don't have to take steps as you used to try to capitalize on the 11.58 on the first death and then have another 11.58 coming on the second death. That was already due to sunset, meaning to expire in 2025, the end of 2025. It would be a relatively non-political bomb to have that sunset earlier than 2025, so that, of course, the Republican side of the aisle will say, "Oh, you're tax crazy, whatever else," to accelerate that from 2025 to now, even as soon as the end of 2021. But all you're doing is bringing an outcome that was already baked into the legislation about sooner. And $11.58 million is still a very, very high historically for the kinds of the type of wealth that is perceived as being that which should be taxable. This is not just, this is oftentimes multi-generational wealth that has accumulated over a couple of generations. There's certainly hedge fund managers that acquire that, just on their own, during their own work years. But, numbers like 12, 15, 20, 30 million are often the scions of commerce that have acquired these over decades and generations. So allowing that to sunset to 11.58 will not be, it would not be viewed as this major political bomb. So so charitable giving could come into play for all these things. So I'll go to the next slide on this. The last point is already there is pressure to make it so it's harder to use retirement planning to defer wealth. It used to be that if you left the retirement asset to a very young person, their minimum required distribution, RMD, the required minimum distribution, might be 1/30th or 1/40th of the value of what they inherit over the course of a year. That's already changed to a 10-year maximum, so they have to withdraw 10% a year. So retirement planning isn't likely to be a big source of tax avoidance or tax deferral. And all of a sudden, for donors' own self-interest, it could be that planned gifts are a viable candidate, for self-interest, not just for the desire to be philanthropic. So I'll go ahead and go to the next slide. And this slide is just a printout from the Naval War College Foundation's planned giving page, which is actually a very robust, very well done page. It has calculators and functionality that, to be honest with you, kind of like the major colleges in the world, major universities, a little bit like Harvard's actually. And part of it's because it is provided by the same sourcing. But it is a very versatile tool that is kind of user-friendly, and it's sort of fun to punch numbers into for if you're a geek and that's your thing. But here's what I've done. This fictional person that invested in Tesla is back here again, and we plugged him into this program. And we're going to call him 59 years old, which reminds me of myself. And except for the fact that I don't have this gain, this is my situation. That if I had a big pile of gain right now, I would be awfully tempted to take some cards off the table. Naval War College Foundation would be one of the places that I'd wish to consider for my philanthropy. And I would look at this as a problem solver for myself in a few ways. One is, I'm not going to be getting a pension from any particular place or retired pay. I'm entirely dependent upon my own 403Bs, 401Ks, that kind of thing. And I would actually love to have a little bit of dependable income that just comes year after year, quarter after quarter, and a planned gift could do that. So for me, I would think, boy, if I could convert that Tesla, which was just a lucky break on my part, into an income stream on $448,000, that'd be kind of neat. And I'm not planning to retire anytime soon, so I don't even care if that income starts right away. I'm going to let that income start 5 years from now, in 2025. If I were to park that money in the form of a charitable gift annuity, it's called a deferred gift annuity, all of the benefits of doing that are kind of spelled out in that those numbers that are in bold below the dollar, the dollar picture there. I would get a $108,000 income tax deduction right now this year. I could do this year. And that it would mean that of the gain that I would have had on that property, $95,000 is never taxed, $96,000. I would all of a sudden have a pension just from the sale of that asset that would start in 2025. That would be, for my lifetime, of $21,541. If I wanted to include my wife, that number drops, measurably, but not precipitously. I think it was going to be $17,000, $18,000. You start to add a couple of lives in there, and the numbers go down a little bit to reflect that added actuarial assumption. When I'm receiving that, each year, part of it is just my money coming back to me. Part of it is the cost basis that I had in the Tesla to begin with, which is called the tax-free portion. So of that $21,000, a couple of $1,000 of it's not taxable at all because it was just my original investment getting returned to me. $14,000 of it each year is capital gains, but there was a period of time after which that capital gains portion goes away once it's been paid off. But you are stretching out over your lifespan the capital gains. And going back to one of the points I raised earlier is by avoiding a situation in which I have $448,000 of unexpected income in 1 year and instead stretching it out into $21,000 over my lifetime, I avoid safely ever being in the category of most of the tax provisions that are aimed at the fairly wealthy. It keeps me comfortably below the top capital gains rate, which kicks in at $449,000 per couple, something like that. Just by avoiding having a spike in income all in one particular year. So I wanted to kind of breeze through my presentation fairly quickly because I'd like to hear from Phil, and I absolutely would welcome questions. But my main point today is it's hard to guess what would be of interest to a lot of people, but I can say that charitable gift annuities in particular, which are something that are very well supported by the Naval War College Foundation's website, have a lot of versatility for people in a lot of different situations. They do have some estate tax savings implications. They're mostly a capital gains device, but a case can be made that you might consider doing one of these things for your own self-interest, and yet you are doing something critically important for the mission of your preferred charities. And what would happen is at the end of all this time frame, those payments will stop, and what remains in that account is turned over to the Naval War College and Naval War College Foundation. And history shows that even if the investment of these funds is being made to support your income payments for your life, usually the overall value of that which gets turned over to the charity approximates that which you gave originally. There's usually a little bit of a burn rate, but historically, a $448,000 gift like this is likely to net the foundation, long time in the future, but net the foundation a few $100,000, $300,000-$400,000 on, in my case, my death, if this were to be my illustration, and if I had happened to had the good sense to buy the Tesla shares I did not buy. So that is the content I wanted to cover, but I would love to have questions.
Eric, thank you. We have about 7 minutes for questions. I don't see anything in the chats yet, but if you do have a question, certainly you can unmute yourself, and if you would introduce yourself and then just announce your question, then Eric can address them as they come in.
Absent questions, which is fine. I will talk about some other functionality of the website and plan giving generally. Plan giving is a broad term, and a lot of plan giving relates to the goal of trying to preserve whatever value you need from assets that have appreciated a lot of times for yourself, but making an irrevocable transfer to your charities, and then getting the current value, the current benefit of the tax deduction, rather than kind of letting that tax value that go to your estate. There isn't a lot that can be done with a charitable gift in an estate other than applying it against that year's income or the federal estate tax if you happen to be above $13 million or $23 million currently. So that what plan giving aims to do is to allow a donor to split the value of a pile of assets and take the current value of that and continue to use that for his or her needs, but to also stretch out the charitable component of the gift. So in addition to stretching out your income to avoid a big spike, you're also allowing the charitable benefit of your gift to be over a long period of time rather than all accumulated towards at the end of your life. So that gifts on death are wonderful, but it is a way to maximize your charitable giving capacity. And there was a question that went on briefly and then it went away again. So anybody know how to retrieve that? It was from John, I believe.
Yes, Eric. Oh, go on, George.
Yeah. So just as Eric, so how many annuitants can I have on a CGA that I contribute? That's from Ann Campbell. Thank you.
You can have multiple. It's less the number than the ages that will dictate the return. So that these things are all based on likelihood of surviving a long term. If it were two 80-year-olds, it won't have much bearing on the income stream back. If you start making gifts to children or grandchildren, it drives the return on those things down. So when people consider creating a charitable gift annuity for a next generation or two generations down, that's where a deferred gift becomes very important, because otherwise the payout will be pretty disappointing. And in some cases, and I think the Naval War College Foundation is one of them, the charity has to say, look, we can't accept this. It doesn't really work from a financial standpoint. We don't want to be paying you 2% a year for 50 years. Can you postpone it for 20 years and then have it kick in? At that point, you've got that back to doing getting a meaningful return on the investment. I actually did do a planned gift 35 years ago. I'd inherited a little bit of money, and it wasn't a great deal, but I did postpone it until I'm 69, which I'm not yet, or actually 65. And the rate is 16%. So it was, I forget if it was 20, 25 years ago. But because I knew that I would be faced with exactly the situation I am, which is a long, a long period of earnings, but then followed by something where I'm not going to have a particular income stream, I did do one of these things. And my rate, because I deferred it for as long as I did, turned out to be, it's a couple of different places, but 15, 16%. So.
Thanks, Eric. We have a couple additional questions and just a couple of minutes left. And what we'll do is the staff too can record these questions, and we can certainly follow up with our guests should we not be able to get to them. The next question in order is when would a direct donation of a required minimum distribution be used instead?
It's a slightly different thing, and it's a good segue to Phil, I believe, but you can use a charitable gift annuity to offset the impact of a required minimum distribution. The way the laws currently work, unfortunately, you can't just take a retirement account and just say, look, I've got a $100,000 retirement account. Can I just do a $100,000 charitable gift annuity with my charity instead and just take the entire thing and roll it into that? That doesn't quite work right now. The main interface between required minimum distributions and charitable giving and charitable gift annuities is if your required minimum distributions are bringing about income for you that you don't really have a use for, you can either accelerate and go beyond your minimum, but plan to use that money for a charitable gift annuity or the like, and at least have an offsetting charitable gift to minimize the impact of the withdrawal. And the last thing is you can use the funding of a charitable gift as that year's charitable required minimum distribution. You can what's called a charitable rollover concept, where you can kind of use that year's required minimum distribution as the source of a charitable gift, and it's a direct one-to-one rollover from one to the other. It would get a little complicated to explain it fully, but it is an opportunity. If you look it up online, it's they try to call it the charitable IRA rollover is how they put that, how it's kind of referred to colloquially.
A good question here. Can you explain the difference between a bequest and a CGA as far as the benefits to the person and to the Naval War College Foundation?
Well, bequests are outright transfers, and they certainly are absolutely the most wonderful thing for a charity to find out about. That they can either be restricted and carry out a particular purpose, or they can be just unrestricted, and it's immediate money available to the foundation. So they're certainly among the most favored things for foundations and charities. I think the main difference, in terms of defining them, is one has virtually no definition to it. It's just a gift. There's no strings attached. There's no benefit trying to be sought to the donor, other than potentially an income tax benefit. And planned gifts tend to say, hey, look, I'd love to be able to give a bequest. I just can't. I need this money enough that I'd like to make sure that I preserve whatever value I need from it in my particular situation. So sometimes planned gifts can be a bigger amount, just historically, than bequests, because people say, yeah, I can do a $10,000 gift, but sometimes people say, I actually could do a $100,000 charitable gift annuity. It's enough win-win for me that I can use that as my big gift.
Thank you. How important is the federal interest rate now at 0.6%?
The higher the interest rate over time, the better the payout on these things will be. That the payout is determined based on the American Council for Gift Annuities, and it's a neutral panel that's designed to say, okay, what can a charity support without losing money on these things? And they're designed to make it so charities do okay. So the fact that we are in a low interest rate environment has a bearing on the rates of return to a donor, and if interest rates were to go up, that's going to help the payout rate. It also has a bearing on the computations of how much of a charitable deduction you get up front. Back on my illustration, that isn't necessary to go back all the way to that, but I envision that a $468,000 gift would generate about $107,000 income tax deduction. If the interest rate were to go way up, that goes up. So the more you're giving up in terms of future earnings on your money, the bigger your income tax deduction would be the year you make it. So that 107 could be a low number historically. It had been that if you were giving about a $400,000 gift, for the most part, you were getting about a $200,000 deduction for it. So the higher the rates, probably the more deduction you're going to get.
Thanks, Eric. It looks like the last question, at least in that chat, do you ever have donors who use CGA payments as future gifts to the foundation?
And one of the things that, obviously there's a whole council of plan giving that does historic tracking of these things. One of the things that is very true about charitable gift annuities is people think I'm going to need that income someday, and lo and behold, they don't. And it becomes almost like their mini foundation. It becomes, they're getting this payment each year that turns out to be not necessary for their life situation, but they're thinking, it's money that's going to go to charity anyway, so they use the payments from that to fund either payments back to the original place that they did their charitable gift annuity to, or as their annual, gifts to 10 different charities. So they can be almost like a little foundation, and way easier than foundations in terms of monitoring and compliance and whatever else. And, in terms of safety, what you get when you do a charitable gift annuity is a promise from the charity, from the Naval War College Foundation, and in a sense, a pledge of its endowment against that gift, because the only true obligations of most charities, there's minor ones here and there, leases and that kind of thing, but the only major binding commitment that a charity typically makes that's an enforceable creditor is your planned giving program. So if a charity has $2 billion of planned gifts and a $40 million endowment, that is about as secure an investment as you can make, because, you got the full faith and credit of that charity's entire $40 million endowment, behind that planned gift.
Eric, thank you very much. A very informative presentation and Q&A session. You obviously presented a lot of thoughtful and helpful information, so well done, and thanks again. And again, I just want to remind, if there's additional questions, obviously you can reach out to the staff. I'm happy to connect you with Eric. I am mindful of the time, so I now want to introduce Naval War College Foundation's own President and Chief Development Officer, Dr. Karl Narowski, former Naval War College Foundation Trustee and Regional Director. Karl has over 30 years of senior leadership experience in the nonprofit sector and has raised millions of dollars in private support benefiting numerous charitable institutions and their constituents. We were fortunate. I'm sorry if you're not. If you can make sure you're on mute, please. Thank you. We were fortunate to have Karl join the Naval War College Foundation, the staff this year, and where she is obviously an expert in all areas of giving and fundraising, including planned giving. Ladies and gentlemen, I pass the mic over to Dr. Karl Narowski.
Thank you, George. And I, too, want to thank all of you on the platform today for joining us and for your interest in the Naval War College, our foundation, and the role planned giving has in advancing our mission to educate today and secure tomorrow. You are vital in our achieving our goal of advancing the work of the Naval War College through philanthropy, and we thank you. A person who is a strong supporter of our foundation to benefit the college is Phil Dunmire. Phil is a member of the Naval War College Foundation Board of Trustees, and as George mentioned, the chair of our governance committee. He is a past national president of the Navy League of the United States. He was awarded the Bronze Star for meritorious service as a U.S. Army Transportation Corps captain serving in Vietnam. He served a total of 11 years in active duty and in the reserve with command and staff positions in Germany and the U.S. And in addition to his military service, Phil has had a successful career in the financial industry with First Wisconsin Trust Company, which is now a part of U.S. Bank, and is chairman of Merchants Bank Corp of Pennsylvania. He is a longtime supporter and member of the Heritage Society, the Planned Giving Society for the Naval War College Foundation. And as George mentioned, members of the Heritage Society's names are listed on a plaque at the college in Spruance Hall. Phil intimately understands the importance of philanthropy and estate planning, and we are fortunate that he and his wife, Linda, have generously remembered the foundation in their estate plans. They want to continue their support of the college in perpetuity. We are honored to have him with us today to briefly share his thoughts on why philanthropy, our college and our foundation and the college play a vital role in his life. We can't thank you and Linda enough, Phil. And ladies and gentlemen, Phil Dunmire.
Thank you, Carla and George, and great to be on the program with Eric. This is a favorite topic of mine. I spent my career in the banking, on the trust and investment side of the banking industry, helping people with their planning and working with people like Eric, their lawyers and accountants and others who advise them on how to conduct their planning. And now, here I am sort of in a shoemaker's children kind of a planning role. Been retired for a number of years, been involved with the Naval War College and the foundation for something like 20 years now. So I've been exposed to the college's faculty, the students, the alumni of the school, some of whom are already heads of the Navy and other services in the countries from which they come. About 20% of the students at the Naval War College come from around the world. So it's been a really magnificent exposure for me and Linda to some degree to the work of the Naval War College, and certainly the operation of the Naval War College Foundation in supporting the Naval War College. Our planning has evolved from days when I was still employed, and we probably made some modest annual contributions to the time frame now where we are retired, have been for a number of years, and the children, and we have grandchildren, and actually our second great-grandchild on the way. So our circumstances have changed over the years. So our annual giving has evolved into some giving that will have more permanence in terms of its benefit at the Naval War College for its permanence at the Naval War College Foundation in supporting the Naval War College. I was, as a trustee, a charter member of the Cyber Task Force. This task force was created at a time which preceded the focus on cyber warfare and the importance of our defense establishment studying at the War College how to defend against the risks from the cyber sector. And so we created a fund some years ago to benefit the study of cyber issues at the Naval War College, and have continued to make some gifts annually to it. But as we periodically review our estate plans, we decided to focus on putting a target on how large we would like that fund to be when we're both gone. So we have rounded it up in the trust and will documents such that when we're both gone, this fund will be rounded up to a larger number than it is today. We've also created a second fund now for a different purpose at the school. But we're sort of living this plan giving experience personally now, rather than my advising others as a trust officer on how to conduct their planning. We're doing it ourselves. So, look at our children are either presently well provided for from either their personal situation or from what they'll benefit from whenever we pass away. And we've got resources, fortunately, that go beyond that. And so we're looking at other ways to accomplish our charitable purposes on top of benefiting the family. I'm 74, soon to be 75. So the yield that comes from placing assets in a trust or in a charitable annuity from assets that otherwise would be taxed, as Eric has so ably described today, with capital gains and otherwise, we can improve our current income with some of these techniques, and the yields at our ages become much more interesting to us. So I guess my message is planning is an evolutionary type of an experience. We, for many years just had wills and trusts in place and didn't look at them or think about them for very often. Now we're reviewing them much more frequently, and we're considering these plan giving issues as we do our annual review of the planning. So be happy to try and respond to any questions that those in the audience may have today, directed at me if you think I can answer something that you may have in your mind.
Phil, thank you kindly for your time, your support and testimonial. The Naval War College Foundation and the college, of course, have benefited a great number of years thanks to your leadership, service, and philanthropy on the Foundation's Board of Trustees. I'll pause for a moment here to see if there's any questions specifically for Phil. If not, I did see another question from Ann pop in that perhaps Eric can address since we got a couple of extra minutes. So any questions for Phil? I know sometimes finding that take the mic off a mute button is challenging. So we're going to just make sure there's no questions from anybody for Phil. Terrific, Phil. Thank you again, Eric. If you're still on the net, does a CGA have to be with a 501c3?
Yes. Am I on? I think I am. Can you hear me or no?
You are. I got you loud and clear. Yes, okay. Thank you.
There are very few exceptions to 501c3s. I mean, you a little bit like a foundation, you can theoretically create something that's compliant, but yes, I think the easiest way to say is yes. And in contrast, you couldn't really do one for a 501c7, for example, which is the typical entity that a yacht club or a tennis club becomes. It's not quite a charity. It's, for the mutual benefit of a lot of people. Those would not qualify. It has to be a 501c3.
Thank you. Thank you, Erica. Any additional questions? Or if I might go back to Karl, if she has any additional comments she would like to make.
Thank you, George. I just want to thank everyone again and let everyone know that we do have, as Eric mentioned, our brand new plan giving website with calculators. So whether you're calculating to make a gift to a charity, whether it is the Naval War College, another charity, several charities, including the Naval War College, feel free to go to our site and use those calculators. And if you have any questions, I know that George is going to talk in a little bit about that. George, you want to talk about the ways to give brochure?
Sure. Thank you. So exciting. I mean, for those of you who are familiar with the website or familiar with the foundation, we were pretty excited back in February to launch a new website, and Carla has been helping us add a lot of meaningful content to it, and part of it is the ways to give, and you can obviously learn about ways to give and so much more about the foundation, and now just by visiting us at nwcfoundation.giftplans.org. So that's nwcfoundation.giftplans.org. If I could sum up today's presentation, again, thank you to our guest speakers, Phil and Eric and Karl. If I could sum it up, I think the best way is say a planned gift is obviously an invaluable way to provide support to the Naval War College Foundation and the Naval War College while accommodating your own personal, financial, estate planning, and philanthropic goals. With some detailed research and planning, I think you've learned that you could actually increase the value of your estate and or reduce the tax burden for your heirs. It can also provide you peace of mind that you have made a significant contribution, something we're very proud of, a significant contribution to the safety and security of your family and friends with a planned gift contribution to the foundation. We recommend that you familiarize yourself with various gift options on our website by exploring how to give and what to give, and then compare the gift options and or calculate how your planned gift could work for you. We also have an available helpful brochure that we would be happy to mail to you that was recently developed. Just please reach out to the staff, reach out to Karla. You can find our contact information on the website as well. The staff, Karla, and the entire staff stand ready to support you as needed. Please feel free to reach out to us at any time for any additional advice or counsel. And of course, we can connect you with Eric as well. We've got 4 minutes left. I know time is precious, so thank you again for your precious time today, and all the very best to all of you for a happy, healthy, and safe holiday season and a very prosperous new year. It's been a pleasure hosting you today, and thanks again for joining us.
Thank you, everyone.